ready to dive into some finance today?
Let's do it.
We're going to be looking at
Yeah.
this chapter from what looks like a finance textbook.
Right.
It's all about the time value of money
Yeah.
and valuing all those
Yeah.
financial instruments.
Yeah. Those tricky financial
Like
instruments.
bonds and stocks and all that stuff. So
Trying to figure out what a bond is really worth.
yeah, how do they
put a price on that?
Yeah, exactly.
Yeah.
So hopefully by the end of this deep dive,
we'll crack the code.
crack the code. Exactly.
Yeah.
So before we get too far into the weeds here,
Sure.
let's talk about this whole idea of time value of money,
All right.
which I feel like I've heard before, but I don't know if I've ever really grasped it.
Yeah, it sounds kind of like a big idea, but...
Yeah, what does it actually mean?
So imagine someone offered you $1,000 today.
Okay.
Or $1,000 in 5 years.
I think I'd rather have the $1,000 today.
Exactly. Why is that?
Well, I could invest it. Right. And it would grow.
It would grow.
Over those 5 years.
Right.
And hopefully I'd have more.
You got it.
Than $1,000 in 5 years. So
yeah. Yeah.
That's, I guess.
That's the essence of the time value of money.
Okay.
The money today is worth more than the same amount in the future.
Got it.
Because of its potential earning power.
Okay, so that makes sense in theory.
Right.
But how does that actually play out when we're talking about like...
Yeah, like these financial instruments.
These financial instruments, yeah.
Right, yeah.
Like bonds, for instance.
Yeah, so the textbook uses something called a pure discount instrument as a way to illustrate this.
Okay.
And one example of that is a zero coupon bond.
Okay.
So let's say you buy this bond for a discounted price, something like $800.
Okay.
And it matures in 10 years and promises to pay you $1,000 at that point.
So essentially, I'm lending someone $800.
Exactly.
With the expectation of getting $1,000 back in 10 years.
Yeah.
So that $200 difference is my profit.
That's right. And that $200 difference represents the time value of money.
Okay.
It's the return you get for letting your money grow.
Interesting.
Over those 10 years.
Okay, so how do we, I mean, I see some formulas in the textbook here.
Right.
Do we actually need to use a calculator to figure all this out?
I mean, the formulas can look intimidating.
Yeah, yeah.
But really, they're just a way to kind of systematize the process.
Mm-hmm.
So let's stick with that zero coupon bond example. We can actually figure out what that bond is worth to you today. Based on that future $1,000 payout and the assumed return that you expect to get over those 10 years.
Right.
Using a little bit of math.
So it's like we're working backwards, kind of, to see what that $1,000 in the future is worth.
Exactly.
In today's terms.
Exactly. We're figuring out the present value.
Okay.
And like the professor emphasizes in the text, it's all about perspective.
Right.
It's like looking at those cash inflows and outflows from the investor's perspective.
Okay.
And understanding that concept of present value is really crucial for comparing different investment options.
Okay, so present value.
Yeah.
Is that kind of like the cornerstone of valuing all of these?
I think so. It's the starting point, yeah.
Okay, great.
And, you know, a financial calculator can make the calculations a little easier, a spreadsheet or something like that.
Sure.
But the core idea is what's important.
Okay, so we talked about zero coupon bonds.
Right.
What about those bonds that do have coupons?
Yeah.
I feel like that might be a little...
They are a bit more involved, yeah.
More involved.
Yeah.
Yeah.
Think of a bond with coupons as kind of like a loan, where you're receiving regular interest payments called coupons.
Okay.
In addition to getting your principal back at maturity.
So it's like getting a little bonus along the way.
Yeah, exactly.
Rather than just waiting for that lump sum at the end.
That's right, yeah.
So that probably appeals to a lot of investors.
Yeah, for sure. Yeah.
So how do we figure out the present value of those?
Well, we need to discount each of those future coupon payments back to today's value, as well as the final principal payment.
Right.
So it gets a little more complex because there's more cash flows.
I can see how that...
They get pretty complex.
Yeah.
So I'm assuming that's where the financial calculator would really come in handy.
Exactly. It would definitely help.
Okay. Well, even without crunching the numbers, I can see how understanding this whole present value thing helps us compare different types of bonds.
Absolutely. It gives us a common framework for evaluating those opportunities.
Yeah.
Okay, so we've covered zero coupon bonds. We've covered bonds with coupons.
Right.
Now let's move on to annuities.
Okay.
They seem to have some similarities, right?
They do, yeah. They both involve regular payments over time.
Yeah, I always think of annuities as like those retirement products
Yes.
where you get like a monthly payment.
Yeah, that's one example.
Is that the basic idea?
Essentially, an annuity is a stream of equal payments
Okay.
over a specified period.
Okay, so like a mortgage.
A mortgage is a good example. You're paying a fixed amount every month to pay down that loan.
Oh, okay, so it's not just those retirement things. It
Right.
could be all sorts of like
Right.
mortgages, car loans, whatever, yeah.
Exactly. Yeah.
So how do we go about valuing those annuities?
Present value is still the key.
Okay.
We need to discount those future payments back to today to figure out what that annuity is worth right now.
Okay. So I'm seeing like this common thread throughout all these different types of instruments. It's all about figuring out that present value.
That's right.
Okay. So we've got the zero coupon bonds, we've got the bonds with coupons, we've got annuities. What about these equity securities? What about stocks?
Yeah, stocks. Those are a bit more challenging
Okay.
because the future cash flows are much less predictable.
Because companies can decide whether to pay a dividend or not.
That's right.
And how much, yeah.
Exactly, yeah. And it really depends on the company's performance and outlook and all sorts of things.
Right. So how do we even begin to value a stock?
Well, there are a few different approaches.
Okay.
But the underlying principle is still the same.
All right.
We need to estimate those future cash flows
Mm-hmm.
and discount them back to today's value.
Okay.
We'll delve into those different approaches a bit later.
Okay.
But for now, let's just kind of solidify our understanding of these foundational concepts.
Okay, sounds good. I'm ready to keep exploring.
Let's do it.
Okay, so we've talked about present value and how it applies to bonds and annuities.
Right.
But I'm ready to tackle these stocks.
Yeah,
You mentioned that they can be a little trickier to value
they can be. Yeah.
because those future cash flows
Right.
aren't as straightforward.
Exactly. Yeah. With bonds, we have those predictable coupon payments or those fixed payments to work with.
Right.
But with stocks, we're dealing with dividends,
Yeah.
which can fluctuate based on the company's performance, their decisions, all sorts of things.
So we can't just plug some numbers into a formula
Yeah.
and get our answer.
Exactly. It's a bit more detective work involved.
Right, right. We have to kind of make an educated guess
Yes.
about what those future dividends might be.
Exactly.
So how do we even begin to approach that?
One common method is to focus on the company's earnings,
Okay.
the profit that they generate.
Mm-hmm.
After all, dividends are typically paid out of earnings.
Right.
So if we can get a sense of how a company's earnings are likely to grow
Yeah.
over time, we can use that as a basis for making some assumptions about their dividends.
Okay.
Yeah.
So if a company is growing really rapidly
Yeah,
and their earnings are increasing,
right.
we might expect that their dividends
You would think so.
would also increase. Yeah.
Exactly, yeah.
Okay.
Of course, companies don't always pay out all of their earnings in dividends.
Right.
They might reinvest some of those profits
Right.
back into the business to fuel further growth.
Yeah.
But analyzing the earnings growth gives us a starting point, at least,
Okay.
for estimating those future dividends.
So it's like we're trying to predict the future a little bit.
We're trying to peek into that crystal ball,
Yeah.
see what their earnings might look like down the road, and base our assumptions on that.
So how do we actually like take those earnings estimates
Right.
and translate that into like a stock valuation?
Right. Well, that's where those valuation models come in
Okay.
that we talked about earlier. One that's widely used is the discounted cash flow model.
Okay. DCF.
DCF, yeah.
I've heard of that.
Yeah, it's all about bringing those future cash flows back to their present value.
Right.
So with the DCF model,
Mm-hmm.
we project the company's future cash flows,
Right.
whether it's dividends or free cash flow,
Okay.
which is, the cash that a company has left over
Mm-hmm.
after paying their operating expenses and capital expenditures.
So we're making like a financial forecast for the company.
Yeah, we are. Exactly. We're trying to project those cash flows
Right.
out into the future, and then we discount those future cash flows back to today
Mm.
using an appropriate discount rate
Mm.
that reflects the riskiness of those cash flows.
Right.
And the sum of all those discounted cash flows
Yeah.
represents the company's intrinsic value,
Okay.
what it's really worth based on those future cash flows.
So it's similar to what we were doing with those bonds and annuities.
Exactly. The same principles apply.
Okay. So we're taking that idea of present value
Yeah.
and just applying it to this more dynamic situation, a more complex.
With company. Yeah.
Exactly.
Yeah.
Okay. Now, I know there's also another approach to valuing stocks,
Right.
which is using multiples,
Yes.
which I feel like I've heard that term thrown around before.
You hear that a lot, yeah.
But I've never really understood what it means.
Yeah, so think of multiples as kind of a shortcut for valuing a company relative to its peers or to the overall market. And one common multiple is the price-to-earnings ratio.
The PE ratio.
The PE ratio, yes.
I've definitely heard of that.
Yep.
But again, I don't really know what it tells us.
So it's a simple way to compare a company's stock price to its earnings per share.
Okay.
So for example, if a company's stock price is $50 and its earnings per share are $5, its PE ratio is 10.
Okay, so we're just dividing the price.
Dividing the price by the earnings.
By the earnings per share. Okay.
So is a higher PE ratio better?
Well, a higher PE ratio suggests that investors are willing to pay more
for each dollar of earnings. So it can indicate that investors are more optimistic about the company's future growth prospects.
So they're expecting those earnings to increase. Okay.
Exactly.
So if we see like a company with a PE ratio that's much higher than its peers, does that mean that the stock is overvalued?
It could. It could mean that the stock is overvalued.
Okay.
Or it could just mean that investors have very high expectations for that company's growth.
Okay.
So it's not a foolproof method.
Right. We have to...
But it's one piece of the puzzle.
Consider other things. Yeah.
Exactly. Yeah.
Okay. So remember how we talked about that inverse relationship between prices and yields? Does that apply to stocks as well?
It does. It plays out in the stock market too.
Okay. Remind me how that works again.
Sure. So think about it this way. When a stock's price goes up, its future expected returns relative to that higher price go down. Essentially, investors are paying more for each dollar of potential future earnings.
So even though it might feel good to see a stock price go up, it also means that our future returns could be lower.
Could be lower. That's right.
Okay, so as investors, we need to kind of keep this in mind.
Exactly.
And not just chase after the stocks that have already gone way up.
Exactly.
Because that might mean that those future returns aren't going to be as good.
That's right.
Okay.
There's always a trade-off, right? There's no free lunch in finance.
No free lunch. Got it.
All right. Good.
Okay, so another important concept that I want to dig into a little bit more is risk aversion.
Okay. Yeah.
I mean, personally, I'm pretty risk averse. I like to stick with the safer investments. Even if it means maybe a slightly lower return.
Right.
Is that pretty common?
That's very common. Yeah, most people are naturally risk averse.
Okay.
To some degree. They prefer certainty over uncertainty, right?
Yeah. Makes sense, yeah. So how does that play out in the financial markets?
Well, if everybody were perfectly comfortable with risk, they wouldn't demand a higher return for investing in riskier assets. But in reality, investors need an incentive to take on that additional risk.
So they need to be compensated.
They do. They need to be compensated for that risk.
Okay, so that's why riskier assets like stocks typically have the potential for a higher return than, say, like bonds. Because there's more risk involved.
That's right. And that's why we see that risk-return spectrum in the market. Safer investments, like government bonds, typically offer lower returns. Whereas riskier investments, like stocks, have the potential for higher return, but they also come with greater volatility and the possibility of losing money.
You could lose money with bonds too, right?
You can, but it's less likely with those safer investments.
Okay, so risk aversion is... I guess it's like one of those fundamental...
It's this important factor
that
shapes the way investments are priced and traded.
Right, and it's built into those...
Exactly. It's reflected those discount rates that we use.
Right, so the discount rate reflects not just the time value of money, but also the riskiness of the investment.
Exactly.
Yeah.
Okay, so that makes sense.
And this brings us to another important concept. Diversification.
Okay, diversification. So not putting all your eggs in one basket.
Exactly.
Right. So how does that play out?
Well, by spreading your investments across different asset classes, industries, geographic regions, you can actually reduce the overall risk of your portfolio.
So it's like a safety net.
It is. It's a way to manage risk without necessarily sacrificing return.
Okay, so how does that tie back to risk aversion?
Well, remember, investors are generally risk averse. They want to minimize their downside risk
Right.
while still aiming for those decent returns.
Yeah.
And diversification helps achieve that balance.
So I can reduce the risk
You can.
without necessarily reducing my potential return.
Exactly. Yeah. It's a very powerful strategy.
Okay. And then another concept
Yes.
that I want to talk about is cash flow additivity.
Right. Yes. We touched on that briefly before.
Yeah, I remember you mentioning it.
So cash flow additivity.
But I'm not sure I totally understand it.
Right. So it's a principle that comes into play
Okay.
when valuing more complex financial instruments or even like entire businesses.
Okay.
It essentially tells us that we can break down a complex stream of cash flows into its individual components.
Okay.
Value each of those cash flows separately, and then add those present values together to get the total value.
This is kind of like a divide and conquer approach.
Exactly. Yep. You break it down into smaller pieces, and then you add them all up.
Right. To get the whole picture.
So give me an example of how that works.
Sure. So the textbook gives a good example.
Okay.
Imagine a security that pays you $100 at the end of year 1.
Okay.
$200 at the end of year 2, and $300 at the end of year 3.
Okay, so we've got these uneven cash flows coming in at different times.
Exactly. Yeah.
So how does cash flow additivity help us with that?
Well, we can treat each of those cash flows as a separate little mini investment.
Yeah,
right. And we can calculate the present value of each of those individual cash flows using an appropriate discount rate, of course.
Right.
And then we just add them up.
And then we just add them all together. Okay.
To get the total present value.
Got it. So it's a way of dealing with those more complex cash flows.
Yeah.
Okay, that makes sense. I like that.
Good. I'm glad.
So I can see how that would be really helpful.
It is. It's a very important principle.
Not just for valuing like securities.
Right.
But even for like, if we're talking about valuing a whole company or something.
It comes into play a lot. Yeah.
Right. Okay.
So let's talk about forward interest rates.
Okay. Forward interest rates.
Yeah. So these rates, as we talked about earlier, kind of give us a glimpse into the future cost of borrowing or lending money.
All right. So it's like we can see what interest rates might be in the future.
A little peek into the future. Yeah.
Okay.
Yeah. And they're derived from what we call spot rates.
Okay.
Which are the interest rates that are prevailing in the market today.
Got it. So how would a business use forward interest rates?
Well, a company that's planning to issue debt in the future might use forward rates to gauge the potential cost of borrowing.
So they
can kind of get a sense.
Anticipate what it might cost them.
Interest rates might be headed,
to borrow money.
Yeah.
Okay.
That's exactly. And investors might use them to make decisions about fixed income investments.
Okay.
Like bonds.
So how do we figure out
So the calculation
what those forward rates are?
Is based on the principle of no arbitrage.
Okay, no arbitrage.
Which essentially states that there should be no opportunities to make risk-free profits.
Right. We've talked about that before.
By exploiting price discrepancies in the market.
Yeah. So how does that apply to forward interest rates?
So to calculate a forward rate, we essentially compare the returns from two different investment strategies.
Okay.
That should, in theory, yield the same results.
Okay.
So, for example, let's say you want to invest money for 2 years.
Okay.
You have two options. You can invest in a 1-year bond today.
Okay.
And then reinvest the proceeds in another 1-year bond a year from now.
Okay.
Or you can invest in a 2-year bond today.
So it's like choosing between a short-term and a long-term.
Exactly. Exactly. And according to the no arbitrage principle, these two strategies should yield the same return over that 2-year period.
Otherwise, there would be an opportunity to make a risk-free profit.
Exactly. Yep.
Okay.
So by equating the returns from these two strategies, we can actually solve for that implied forward rate.
So it's like a mathematical puzzle that tells us...
It is a bit of a puzzle.
What that future interest rate might be. Okay. So
the forward rates can give us insights into market expectations about future economic conditions.
Okay.
So, for example, if forward rates are higher than current spot rates, it suggests that the market expects interest rates to rise.
So if they're expecting rates to rise, maybe they're expecting inflation to rise as well.
It could be. It could be inflation. It could be...
Or stronger economic growth.
Stronger economic growth, all sorts of factors that could be driving those expectations.
Okay, so forward rates are giving us like...
They give us some clues.
clues about what might happen in the future.
Yeah, they're not a perfect predictor.
Right.
But they can be helpful.
Okay, great. So let's move on.
Okay.
To options.
Options, all right?
So options give the holder the right, but not the obligation.
That's right.
To buy or sell an asset.
Yeah.
At a specific price.
At a specific price.
Within a specific time frame.
That's right.
So it's kind of like
it gives you that
safety net.
Flexibility, yeah.
Yeah.
That option to buy or sell.
So how do we go about valuing options?
Right. So valuing options can be quite complex.
Okay.
It involves considering a number of different factors. The underlying asset's price, the option's strike price, the time to expiration, the volatility of the underlying asset, interest rates.
So there are a lot of moving parts.
There are a lot of factors to consider, yeah.
Okay, so are there models that can help us with this?
There are. There are option pricing models that have been developed to help estimate
the fair value of these options.
So we can figure out how much an option is actually worth.
Yeah, given all of those factors that we just talked about.
Okay. And what's like
one of the most widely used
model?
Option pricing models is the Black-Scholes model.
Okay, the Black-Scholes model. I feel like I've heard of that.
You probably have, yeah. It's very well known.
But I don't really know anything about it.
So it might seem intimidating at first.
Yeah, it does sound a little...
But the logic behind it
intimidating.
Is actually quite elegant.
Okay.
It relies on that principle of no arbitrage.
Right. No arbitrage again.
Similar to how we calculate those forward interest rates.
Right. Okay.
So the Black-Scholes model essentially creates a theoretical portfolio that replicates the payoff of the option.
Okay, a theoretical portfolio.
So this portfolio typically involves holding a certain amount of the underlying asset and then borrowing or lending money at the risk-free rate.
To create a portfolio that mimics the behavior of the option.
Got it. Okay.
And by ensuring that this portfolio has the same payoff as the option in all possible future scenarios, we can determine the option's fair value.
So we're kind of like mirroring
the option.
The option with this portfolio.
Exactly.
Okay, so how does the model actually calculate that fair value?
Well, it uses a pretty sophisticated mathematical formula to take into account all those factors that we talked about earlier.
The price of the underlying asset, the strike price.
The time to expiration, the volatility, all of that.
Right. But again, it's all based on this principle.
It is. It all comes back to no arbitrage.
Of no arbitrage.
Making sure there's no opportunities for those risk-free profits.
Okay, so that makes sense to me, I think.
Good, I'm glad.
I mean, I don't think I could go out and actually use the Black-Scholes model.
Right.
But I understand, kind of.
You understand the basic idea.
The idea behind it.
Which is what's important.
Okay, great.
Yeah, and there are plenty of online calculators and tools that can help you apply the model.
So I don't have to do all that math myself?
You don't, thank goodness.
Okay, good. So are there any other option pricing models?
There are, yeah.
That we should be aware of?
Let's talk about the binomial model.
Okay, binomial model.
Which we touched on briefly before.
Yeah, I think I remember you mentioning.
Yeah, so it's a simplified approach to option pricing.
Okay.
That uses what we call a tree-like structure.
Okay.
To model the potential price movements of the underlying asset.
Right, so it shows us
over time
all the different ways the price could go.
Exactly, it maps out all the different possibilities.
Yeah. Up or down.
Up or down.
Okay.
So each branch of the tree represents a possible price outcome, either an up move or a down move.
Okay.
And we assign probabilities to each price path, and we discount the option's payoff at each endpoint back to the present to estimate the option's value today.
So it's a little more, I guess, it's a little more
visual than the Black-Scholes model.
Okay, so walk me through an example of how that works.
Sure, so let's imagine we have a call option on a stock that's currently trading at $50.
Okay.
The option's strike price is also $50, and it bears in 1 year.
Okay, I'm following so far.
All right, go.
So we've got a call option, strike price of 50, expires in 1 year.
And let's assume that the stock can either go up by 20% or down by 20%. In 1 year.
Okay.
So this means that at expiration, the stock will either be worth $60 or $40.
So it's either up or down 20%.
Up or down 20%. Right. That's the essence of the binomial model.
Got it. So at expiration, the call option is going to be worth?
It'll be worth $10.
$10.
If the stock goes up to 60.
Okay.
And it'll be worthless if the stock goes down to 40.
Right, because a call option gives us the right to buy at 50.
Exactly.
So if it's below 50...
If it's below 50, it's worthless.
The option's not worth anything.
That's right.
Okay, so how do we...
So to calculate the option's value today, we need to work backward through that binomial tree, discounting those future payoffs back to the present.
And what discount rate do we use?
So that's where we use what we call risk-neutral probabilities.
Okay, risk-neutral probabilities.
Which don't necessarily reflect our actual beliefs about the stock's future movements.
Right.
But they create a risk-neutral environment.
Got it.
For valuation purposes.
Right. So we're not trying to predict
not exactly
whether the stock's going to go up or down.
We're creating a theoretical framework where investors are indifferent to risk.
Okay, so how do we calculate?
So there's a specific formula.
Those risk-neutral probabilities.
That takes into account the risk-free rate, the time to expiration, and the potential up and down moves of the stock price.
Okay. And then once we have those,
we
can use those to discount.
We can discount those payoffs back to the present.
The future payoffs.
Yeah, taking into account the probability of each outcome.
So we're basically weighting...
We're weighting those payoffs.
Those payoffs?
By their probability.
By their probabilities.
Yes.
Okay, and then we add all those up.
Add them all up.
And that gives us...
And that gives us the option's present value. The present value of the option.
Or its theoretical price.
All right, so that's the binomial model.
That's the binomial model.
Okay, I like that.
Yeah, it's a bit more intuitive.
It's a little bit easier to grasp.
It is. It's a little simpler.
Than that black skull.
And the black skulls, yeah.
That model.
Yeah.
Okay, this has been really eye-opening.
Yeah, we've covered a lot of ground.
I feel like I've learned so much. I'm glad.
Wow, we've really covered a lot of ground in this deep dive.
We have. It's been quite a journey.
From present value to valuing options and everything in between.
It's a lot to take in.
It is, but I feel like I've come away with a much better understanding of how all these pieces fit together.
I'm glad to hear that.
And how those valuations actually work. So before we wrap up, I'm curious.
Sure.
Are there any other, big picture ideas or takeaways?
Yeah, there are a few.
That we should be thinking about?
That kind of weave through everything we've talked about.
Okay.
One is the idea of information asymmetry.
Information asymmetry.
Which basically means that in any financial transaction, one party often has more information than the other.
Okay, so like a used car salesman.
Exactly, yeah.
Who knows, the car has problems.
Right.
But the buyer doesn't.
That's a classic example.
Okay.
And this information imbalance can create all sorts of issues.
Right, because the buyer might not...
Right, they might not be willing to pay a fair price.
Yeah.
If they're worried about those hidden risks. Right.
Right. Okay. And the seller might.
Then a seller might try to take advantage of the buyer's lack of knowledge.
Okay. So how does this, play out?
So it's everywhere in finance.
Yeah.
You see it in the stock market, for instance.
Okay.
Company insiders might have information about upcoming earnings or new products that the general public doesn't.
So they could use that information.
And they could potentially profit from that before it becomes public.
Okay, so that's why we have all these rules.
Exactly. That's why insider trading is illegal.
Against insider trading.
Right. And regulators try to level the playing field by requiring companies to disclose material information to the public.
Right. So everybody has access
to the
same information.
Everybody has access to the same information.
But in reality...
But even with regulations...
It's not always the case.
That information asymmetry always exists.
Okay, so as investors, how do we deal with that?
That's where due diligence comes in.
Okay.
We can't eliminate information asymmetry completely.
Right.
But we can try to mitigate its effects.
Okay.
By doing our research, carefully evaluating investments, and being aware of our own biases.
So really just being thorough.
Yeah, asking the right questions,
yeah.
Seeking out reliable information, not just taking things at face value.
It's like we're financial detectives.
Exactly.
Yeah.
And speaking of detectives, another big takeaway from our deep dive is the importance of critical thinking.
Yes, absolutely. This whole conversation has been an exercise in critical thinking.
It has. It's about questioning assumptions.
Right.
Evaluating evidence, connecting the dots.
And not just blindly following formulas.
Exactly.
Or trusting the experts.
You've got to understand the underlying logic.
Right.
Assess the risks. Make your own judgments.
So we have to be skeptical.
But also open-minded.
Open-minded.
Okay.
Willing to challenge conventional wisdom, but also grounded in those sound principles.
I love, so This deep dive has really been so much more than just about finance.
It has.
It's about critical thinking.
Yeah.
It's about information literacy.
Right.
It's even a little bit about philosophy.
I think so.
So as we wrap up this deep dive,
Yeah.
I'm feeling a sense of accomplishment,
Okay.
but also like a renewed sense of curiosity.
I love that.
I feel like I've learned so much.
That's the goal.
But there's still so much more to learn.
There's always more to learn.
So thank you so much for guiding us through all of this.
It's been my pleasure.
It's been a fascinating journey.
It has. It has.
So to our listeners out there, we hope this deep dive has sparked your curiosity about finance.
Absolutely.
And given you the tools to
kind
of take control of your own
financial well-being.
So
keep learning, keep exploring.
And keep diving deep.
We'll see you next time.